Exercise 9.1 is a good place to start because it gives us an overview into the difference between stock financing of your company and bond financing of your company. So-called raising your capital by selling equity, stock, or raising your capital by borrowing, selling bonds. So let's talk about selling bonds first. If we're selling the bonds and they tell us that the bonds are 7% bonds and are sold at face rate, so that's 7% of 11 million, that's 2,450,000. That's the interest for the bonds, 2,450,000. And remember, that's tax deductible. So we get to deduct that to come up with our income before tax of 8,550,000. Then we take our tax, which is 35% for both companies, and in this case that's 2,992,500. Yeah, and you and I complain about paying income tax. And our net income is $5,557,500. Now they tell us that we have 400,000 shareholders. So each of those 400,000 shareholders gets a little piece of that 5,557,000. So we take the 5,557,000, 5,557,500, divide that by our 4 million number of shares, which they give us in the problem. And when we do all that, we find out that each shareholder, that 4 million, each of those shareholders, his earnings per share of stock is $1.39. That's if we issue bonds. Now we're going to make pretend the company does the same exact thing, but instead of issuing bonds, issues stock, sells stock. So they have no interest expense that they can deduct. So that means that their income before tax is the full 11 million. And their tax is 35% of that. That's 3,850,000. So the net income after tax is 7,150,000. So that's about $1,593,000 more than the same company issuing bonds. Now, suppose they have 5 million shares, and they told us that we have 5 million shareholders. We're going to divide the 7,150,000 by 5 million, and that gives us $1.43 a share. So look at the difference to the shareholders. Although this company made almost $1,600,000 more, their shareholders really only got a few pennies more per share. Now they have more shareholders, but let's make it even. Let's make pretend that both companies have 5 million shareholders. This is not part of the problem. This is make pretend. If they did that, we would take the 5 million into the 557. That would be $1.11. So even with the extra shareholders, they're only making an additional 30 cents on that $1.6 million worth of additional income. And that's the benefit of debt financing, because you don't have to pay tax on the debt, but you do have to pay tax on everything else, and then you make your distribution from that.